Good morning. My name is Greg Upton. I'm the Interim Executive Director and Associate Research Professor here at the LSU Center for Energy Studies. Welcome to our 2024 Gulf Coast Energy Outlook Kickoff. We especially welcome those of you who might not be familiar with the Center for Energy Studies, or CES as we call it. CES is a unique research unit at LSU, and that we were created by the Louisiana legislature in 1982. We're mandated to provide energy information and analysis that responds to the needs of the legislature, public agencies, business and civic groups, as well as the general public. The annual Gulf Coast Energy Outlook is one way that we fulfill this mandate. The majority of our funding comes from the legislature through LSU. We also participate in funded research through federal and state agencies, as well as private companies. We pride ourselves in our diverse constituency and funding sources, which allow us to provide analysis without a political or economic agenda. We also thank CES's sustaining members from across the energy value chain, including at the platinum level, the Baton Rouge Clean Air Coalition, Entergy, ExxonMobil, Oxy, and Shell. The gold level, we have Chevron, Phillips 66, and Talos Energy. The silver level, we have Cleco and Placid Refining. At the bronze level, the Southwestern Electric Power Company, or SWEPCO, Koch Industries, Louisiana Department of Natural Resources, and the Louisiana Oil and Gas Association, or LOGA. At the contributor level, we have Iser Amper, Hood Bauman and Associates, Keen Miller, Louisiana Economic Development, Log Exploration, and the TJC Group. If your organization is not on the list, please consider becoming a CES sustaining member at any time by visiting lsu.edu/CES and clicking on Support CES. I'd also like to thank the dozens of individuals from industry, government, trade organizations, and academics who spent their valuable time speaking with me this fall in preparation of this year's Outlook. While crunching the numbers and the modeling are of course, very important, equally as important is this input from stakeholders. It simply wouldn't be possible without you, so thank you. A very brief agenda for today. I'm going to start off with discussing the big picture uncertainties and modeling assumptions that we're going to use in the Outlook. I'm going to then move into the different parts of the energy value chain. We'll then switch over to former executive director and professor emeritus, Dr. David Dismukes, who will discuss the electricity sector, industrial developments, and energy exports. Then we'll switch back over to me to present the upstream oil and gas employment forecasts. This year, we're very excited to welcome Greg Albrecht, research fellow at CES, who also contributed to the Outlook for the first time. Greg served as the chief economist of the Louisiana Legislative Fiscal Office for many years until his recent retirement. And Greg has contributed to the refining and chemical manufacturing employment forecast, which he will present today. If you have any questions, please type them in the Q&A on Zoom at any time throughout, and we'll do our very best to leave time at the end for questions, to answer those questions. As you consider asking questions, please do keep in mind that the webinar will be recorded and will be posted online after. The Outlook itself is now available on the Center's website and will be put here into the chat feature on Zoom. So please take a look. Also, in addition to the Outlook document itself, as well as the slide deck, which we'll show today, we have even more slides that are also posted on the Center's website, which are data and analysis that we view in preparation of the Outlook that don't actually make it into the document or slide deck today as well. So please feel free to use that as a resource as well. All right. So here's the kind of outline. What we're going to do, we're going to start off really and talk about the big picture introductions and uncertainties. So the first question I'm going to ask is a recession still on the horizon? This was discussion a year ago. You might recall our Outlook. Everyone was forecasting that a recession was going to happen this year. Did that happen? Is it going to happen in the future? We'll talk about that. Then we're going to talk about decarbonization efforts. And in particular, the increased discussion I'm hearing of balancing cost competitiveness and emissions reductions. How do we think about that as a risk or an opportunity for our region? Third, I'm going to talk about what we've learned from the Russian invasion of Ukraine. It's been just absolutely incredible to see how resilient energy markets have been this past year. We'll talk about that very briefly. I'll then talk about some supply restrictive policies, such as in particular with offshore leasing. And then we're going to talk about permitting and whether that is the new bottleneck that might be holding up some of these project developments. So this right here is United States non-farm employment. So this is what economists refer to as the establishment survey. Most of the time, whenever you read in the news the jobs report, this is the survey that it's referring to. And as you can see here, we of course had the 1990s, you had the expansion, then you had the oil price shock in the early 2001, which led to a recession. Then you had the expansion, and then of course you had the financial crisis, and then we had the longest period of expansion in U.S. history since World War II, actually. And then of course right here you have the pandemic. The pandemic was extremely sudden. A very different looking recession than these kind of rolling business cycles in the past. The best estimate is that the worst month, we were 14% below the pre-pandemic peak. The good news is that we've reached our pre-pandemic employment in June of 2022. And the most recent month of data out now, which is October, we're about 3% above the pre-pandemic peak. Please note that these numbers are revised, and they can be revised for up to a year after they come out. But the bottom line is right now, the U.S. economy is not looking like it's in a recession. We've got employment growth has continued. So there's a famous saying by Paul Samuelson, at least it's attributed to Paul Samuelson. I actually looked, I couldn't find where he actually said this, but the quote is, the stock market has predicted 9 of the last 5 recessions. And that's kind of what we saw last year. Everyone this last year was saying we're going to have a recession coming. The stock market adjusted. But that just recession to date has not come. It doesn't mean it can't come, but it certainly hasn't to date. And we can see the stock market rebounding there. The thing last year that we had highlighted in the outlook that we were very concerned about was the fact that that wage growth was happening at a slower clip than inflation. And so this year shows a measure of inflation using the consumer price index. And so as you can see, historically, you've got wage growth is happening at a faster clip than inflation. And in the long run, that's what creates economic growth. Wages rise a little bit faster than inflation. And when you accumulate that over many decades, that's how we experience economic growth. But as you can see, we had this run up in inflation where inflation was happening faster than wage growth. And this really, to me, is the fundamental reason why a lot of people were forecasting a recession. The good news, according to the Consumer Price Index, today wage growth is back outpacing inflation, according to this measure. Interestingly, though, the Fed's preferred measure of inflation, which is called the PCE, or the Personal Consumption Expenditure Index, which they've been using as their preferred for about the last 20 years or so. Again, you had wage growth was not keeping up with inflation. Inflation has declined, but according to that index, we're actually about in balance. So there is a question of whether or not recession's on the horizon. Our outlook doesn't consider that to be the case, but again, it definitely could be. So what's happened to energy consumption over the last decade? In the United States, energy consumption has been relatively flat. That's happened. We've had economic growth on one hand, and then we've had economic growth on one hand, which leads to an increase in energy demand. But on the other hand, we've had efficiency gains. Fuel efficiency of cars have gotten more efficient. Appliances have gotten more efficient. And in the US, those two are about in balance. And what's interesting, according to EIA's annual energy outlook, that's forecasted to be about in balance for the next year. So energy demand, or for the next decade, I'm sorry. So energy demand in the United States has been flat. And our outlook anticipates that continues to be flat in the future. But energy supply, of course, has increased precipitously over this last decade. I don't have to tell the audience of this outlook. We've had enormous increases in oil production, natural gas production, renewable energy production over this decade. And EIA anticipates that energy supply will continue to increase out to 2050, actually, here in the US. So what's facilitating that? Of course, that's facilitated by international demand for the products that we produce here in the Gulf Coast. And that's really a core piece of our outlook, not just this year, but in prior years. The billions of investment that we're seeing coming into southern Louisiana, as well as into Texas, that kind of energy corridor is being expanded due to the export potential. We've got supply of these products here, and we're exporting those all over the world. As you can see, what's kind of interesting, the EU actually has not experienced real GDP growth in about a decade. The United States has continued to see GDP growth over that decade, as well as Japan has not seen GDP growth over that decade. Really, where that growth has come from is from the developing world, in particular China here, which has grown rapidly, as well as India there. You can see this on a GDP per capita basis, which shows the same thing. The US is enormously productive in terms of on a global standpoint. In fact, we're more productive today relative to the EU and Japan than we have been in a decade, which is fascinating. But again, that growth is really going to come from that developing world, which has a lot of growth ahead of it. So is a recession still on the horizon? This year, our modeling will assume that inflation continues to gradually slow to the Federal Reserve's target of 2 to 3% over the next few years. Wage growth will gradually begin to outpace inflation, and demand for energy global will continue to rise. GCEO, much like past years, anticipates that long-run energy demand growth will lead to increased U.S. energy exports, especially to the growing developing world. If the global market enters into a contraction over this year, this could make our forecast a little bit too optimistic. All right, so big uncertainty too is decarbonization efforts, balancing cost competitiveness and emissions reductions. So decarbonization, particularly industrial decarbonization, continues to take on a new level of importance and urgency each year when I'm speaking with firms, and we'll show that in our infrastructure numbers, actually the growth in the investments in decarbonizing the sector. We're still in the beginning phases of the IRA, which we discussed last year when it was newly passed, but we're still less than 2 years in, and this is a 10-year of spending on emissions reductions. And so, as you might recall, energy and climate accounted for 84% of the bill's spending. So despite the name, the Inflation Reduction Act, this was very much a stimulus bill aimed at reducing emissions in the energy sector. 3 stylized facts that are important that I just covered. Number 1, energy demand growth has been flat. Energy production has increased. Oil increased by 83%, natural gas by 47%, and renewable by 51% over the last decade. And energy production growth is facilitated by these exports. This is so important for us because as we export these products to the global market, increasingly a key competitive feature is going to be our emissions intensity relative to those other global markets. But if we go too far and we spend too much reducing emissions, we might find that we're no longer cost competitive, and in which case we might lose that market share on that global market. But on the other hand, like we kind of take the ostrich approach and put our head in the sand and say, look, we're only going to focus on cost competitiveness and not think about our emissions intensity, we might find other parts of the world producing these same products at a lower emissions intensity, which might lead to us selling our products onto the global market at a discount. And so I think the big key that I see is the balancing act of these two things: emissions competitiveness and cost competitiveness. This, is kind of illustrated in the emissions here in Louisiana versus the U.S. This is from the greenhouse gas inventory that David had done for the governor's task force a few years ago. 2/3 of Louisiana's emissions are industrial emissions. This is very different than the rest of the United States, where industrial emissions are a distant 3rd place in terms of total behind transportation and electricity. So as our energy sector tries to decarbonize, it's a fundamentally different conversation here in terms of industrial decarbonization than the rest of the U.S., which is primarily electricity and transportation. Not that those things, we don't have those things here, but in terms of a relative share, of course, they're less important. The CO2 emissions intensity of real gross domestic product in the U.S. has cut in over half over the past half century, and this is the trajectory that we anticipate continues. Interestingly, when you compare us to other global economies, the U.S. is very, very competitive. So so the emissions intensity in China is 320% higher than the U.S., India 450% higher, and Russia's 441% higher. And so as we think about global trade, as Senator Cassidy, of course, has his new bill that he's recently released, really thinking about how we think about our emissions intensity in terms of a global competitiveness, I think is going to increasingly be important. All right. So risk or opportunity? This is the big question. Decarbonization will not only challenge Gulf Coast energy manufacturing, but it'll also create an opportunity in the development of product capacity for liquid fuels, chemicals, plastics, fertilizers, and other products historically derived from fossil fuels. The goal is to have lower or even potentially net zero greenhouse gas emissions, which many firms have made these net zero commitments over the next several decades. Companies are actively considering the most efficient way to achieve these meaningful emissions reductions, given the subsidies that are currently available over the IRA. Over the forecast horizon, we actually see this creating considerable regional capital investment opportunities, and David's going to talk about that. Over a third of the investments that are out there today are actually decarbonization based. But the longer term effects of decarbonization on the region is candidly more nuanced. It's a little bit harder to see. And in my opinion, will be determined by our ability to achieve emissions reduction in a cost competitive way, alongside the global market's willingness to pay a premium for those lower emissions intensity products. And to me, those are the two factors that are going to really determine how this impacts our region in the world. So next, third, what have we learned from the Russian invasion of Ukraine? So this is a figure right out of last year's GCEO that I want to juxtapose of what happened. So as you can see, that red line there, that is, as you can see, the red line there, that is the week before, the days before the Russian invasion of Ukraine. And as you can see, markets were in backwardation for both oil and natural gas, meaning that oil and natural gas prices were anticipated to decrease over the coming years. And the reason for that's really basic. You had the supply shock, prices were relatively high. Before the Russian invasion, you had demand coming back post-pandemic. Production was coming on with a lag. And this really and so therefore markets thought that production was going to come online and lead to a reduction in prices. But of course, when Russia invaded Ukraine, that is not what happened. Russia is the second largest producer of natural gas globally, the third largest producer of oil globally. And and whenever we implemented all of the sanctions, as well as, workers from Western companies not going and working in Ukraine, what this did is this put a supply shock on the market. And so as supply shock occurred, this of course will lead to upward increase in prices, which of course impacted consumers here. What was interesting in last year's GCEO, what we saw is that futures, even by last November, were already anticipating pretty rapid adjustment to the pre-Russian level of Ukraine levels. And oil prices were anticipated to converge to pre-invasion levels, while natural gas prices were anticipated to be permanently about $1 per MCF higher. We view this as the market for LNG was going to expand. People are going to be willing to pay a premium for the natural gas from the more geopolitically stable region of the world, and therefore this would tie U.S. natural gas markets a little bit closer to those international markets. So let's see what happened. What's been interesting, and we talk about the kind of different three epochs of prices in the energy outlook and in prior years. I won't cover them again here today. But as you can see here, these are inflation-adjusted prices of both oil and natural gas. And as you can see, over the last several years, markets have anticipated oil and gas prices to be relatively low and relatively unstable. And as you can see, despite this enormously large supply shock, what happened last year with the Russian invasion of Ukraine, markets are back in that kind of band for which we had anticipated. And so last year we had asked the question of, have we entered into a new era, a new epoch of higher prices due to this supply shock and this geopolitical instability? And the answer to that so far has been no. Markets have been incredibly resilient to that, which to me has been one of the most fascinating things to see over this last year. And so this shows this shows futures markets over the last 3 years. And as you can see, markets are kind of anticipating business as usual moving forward. In fact, anticipating lower oil prices into the future. And this is what you see for natural gas prices. So it's just been incredible to see how quick global markets have adjusted to this and how resilient they've been to that shock. This shows natural gas prices for TTF, which is in the Europe market, JKM, which is the Asian market, and Henry Hub here. And as you can see, and we'll talk about a little bit more with midstream constraints, we will continue to have a pretty big cost advantage in terms of natural gas prices here in the United States, which is going to be really important for that industrial development that David's going to talk about here in a little bit, not only in terms of LNG export capacity, but also in terms of all the chemical manufacturing that takes that natural gas and process it into plastics, chemicals, fertilizers, all of these goods and services, all these goods that we export globally. So we'll continue to see a competitive advantage for the Gulf Coast region for that. So what have we learned? GCEO modeling will assume that the war in Ukraine continues, as does Western sanctions on Russia. Global commodity prices have largely already adjusted to this global supply shock, candidly way more quickly than I had even anticipated last year. And then the effects will continue to attenuate as time passes. The Russian invasion of Ukraine has increased the international importance of our region as a global energy provider. All right, so supply restrictive policy. So last year, as you can recall, we had talked about President Biden was elected, and he came in and he signed the executive order, which, quote, paused new oil and gas leases on public lands and waters while a review was completed of these leasing practices. This went back and forth in the court systems, which we covered in last year's Energy Outlook. And then, of course, last August, the Inflation Reduction Act was signed into law. What was interesting in the Inflation Reduction Act, there was a provision which required the federal government to implement a oil and gas lease in the Gulf of Mexico within so many days of wind leases being held. And so one of the questions that we asked last year is maybe this uncertainty has been resolved. But that's unfortunately, this is not what has occurred. After the IRA was passed, there was a lease sale that was put out there, that was announced, but there's again been back and forth on these lease sales. And so I'm not going to go through the entire timeline here. We could do an entire hour webinar just on that. But as you can see in the outlook itself, you can see the detailed timeline in terms of where we are there. So GCEO modeling considers uncertainty around reduced levels of offshore leasing over the forecast horizon, which is 3 years for us. Effects on employment are likely to be small. And the reason for that is really because these are longer term projects that are out there. When I talk to people in the offshore space, that's pretty much what I've been told is, look, this definitely in terms of the long term can have big implications, but in terms of the next year, 2 years, 3 years, those effects on employment are likely small. So long-term implications of oil and gas supplies and upstream employment are likely to be larger if uncertainty around offshore leasing continues into the future. So this is a big question mark in my mind. And by the way, not only does this impact those firms that are in the upstream oil and gas production space, but it also impacts those firms who are looking to make long-term investments here in manufacturing those hydrocarbons. If the United States and this region is looked at as not having a consistent supply of those hydrocarbons into the future, consistent policies, not only could that negatively impact those industries that produce those hydrocarbons, but also the firms that use those as feedstocks and making those investments. And finally, permitting, our last uncertainty, the new bottleneck. And last year, prior years GCEO, we talked about all of these supply chain constraints. We talked about 4 sources of supply chain constraints, and I'm not going to go over again each in detail, but they were in last year's outlook and they're described in the document this year. But the first was the economic recovery from COVID, the uncertainty that created. The second was we were at full employment plus all of this economic stimulus. Of course, whenever you stimulate the economy at full employment, what does that do? That creates inflation, which is exactly what we observed. We then had the Russian invasion of Ukraine and the resulting sanctions, which again created enormous supply chain constraint. And then we had this trend towards what's called deglobalization. And we gave multiple examples of that from the Trump trade wars to Brexit to now the Biden administration's Inflation Reduction Act, of course, has all of these trade provisions in it, made in America. We can talk about globalization and the impact on prices for consumers and efficiency, et cetera. But the bottom line is there's been a movement on both the political left and the right in the United States, and by the way, globally and in other developing countries such as Western Europe, to be more concerned with producing things locally, and economists refer to this as global deglobalization, which again creates supply chain constraints. What's been interesting this last year is that now I'm hearing more with all these IRA investments, I'm hearing more on the permitting being the bottleneck than the supply chain constraints that we were here in the last few years. So GCEO modeling assumes that global supply chain constraints continue to attenuate, while uncertainty around permitting presents a more immediate bottleneck in project development. We actually, interesting with this, we put out a white paper, very short white paper called What is Carbon Capture, Utilization, and Storage this last year, because of all of the questions around Class 6 primacy. What is this new technology? And you can go access on our website here. But this is just one example of those permitting bottlenecks that we've experienced over this last year. Okay, so now we're going to move kind of very quickly through the energy supply chain, kind of hit the high points. Again, these slides, as well as even more slides, or on the Center for Energy Justice website that you can go check out. So let's talk about upstream activity. Oil production has just eclipsed the pre-pandemic peak in the U.S., and natural gas production is actually 6% above that pre-pandemic peak. So oil and gas production have both recovered. In the U.S., you can see we've seen an increasing share of the U.S. Of oil production, share of global oil production, that continues to increase now as production is climbing. Interestingly, in the Gulf Coast, oil production eclipsed pre-pandemic levels in September of 2022, and it's currently 8.4% higher. So the Gulf Coast region has really been where a lot of this production has come back from. Natural gas production is now 17% above the pre-pandemic peak in the Gulf Coast region. So lots of growth in oil and gas production. The rig count has been slowing down over the last several months here, and that will actually feed in a little bit into our employment forecast. Interestingly, production continues to be strong, and a lot of that we see is continued, and this has been a theme over the last several years when talking about the upstream space. We simply need less inputs in order to create more inputs. More efficiency is what's driving the increase in oil and gas production we've seen here in the United States. So this is the U.S. rig count, and if you kind of squint your eyes and ignore this vertical axis here, this shows you the Texas rig count, and if you flip back and forth between those, they look very similar. As you can see, the Louisiana rig count looks very different, and a lot of that has to do with the shale formations, for which you still have a lot of volatility, ups and downs, boom and busts. While in Louisiana, we have more exposure to that offshore oil and gas production, and that is going to be less volatile moving forward. I mean, you can see that in the number of Louisiana well completions, and this is in Louisiana state lands and water bottoms, does not include the federal offshore. And as you can see, we've kind of reached this new level relative to the 2014 price crash, and we're not anticipating that we're going to go back to that. This shows you that the Permian is the premier play here. That's really a lot of the swing in rig counts. In the Haynesville, has continued to see growth. We've seen a little bit of downward pressure on production this last year because of the low prices, but Haynesville, I think, has a lot of many years ahead of it. This is the Prodcast model from Enverus, and Prodcast is forecasting that we will have an increase in oil production in the Gulf Coast region and in the U.S. Over the next decade. And as you can see, that increase in production is going to be driven by this Gulf Coast region. The rest of the U.S. is anticipated to be flat. So in terms of our outlook, we think that despite decarbonization efforts and everything else going on, oil production from within the U.S. is forecasted to increase out for at least the next decade. You can see the last few years, and this has been a consistent theme of the energy outlook for both the U.S. and the Gulf Coast. Natural gas production, we see a similar trend. Now, it's a little bit more balanced, the Gulf Coast relative to the rest of the U.S., but as you can see here, again, we project an increase in natural gas production nationally over the next decade, okay? And this, again, has been a theme for us. So in terms of oil and gas production, these are anticipated to increase over the next decade. All right, so the value of production, so what we do is we take the historical production, we multiply that by the price, and then we merge that with the Enverus production forecast as well as the futures market prices. And this is fundamentally what goes into our employment forecast for the upstream oil and gas sector, which I'll talk about here in a minute. Okay, and this is for the Gulf Coast as well as the U.S. All right, so very quickly, I'm going to talk about midstream constraints within the United States. Oil markets are approximately in balance. This is if you've seen the GCEO in former years, this is kind of our go-to to look at oil movement constraints within the U.S. You've got the vast majority of oil being shipped by pipeline. Whenever you start seeing pipeline constraints, that's when you have an increased share of rail and tanker, and that correlates with the price difference between West Texas Intermediate and Louisiana Light Sweet. So oil markets are approximately within balance in the U.S. as oil production, and this isn't surprising given U.S. oil production has just returned to those pre-pandemic levels. As it increases, we'll see what kind of development in terms of oil pipelines might or might not be needed. So that's something we'll be watching. But in terms of globally, as you can see here, that Brent and WTI have moved in tandem. We'll actually see that WTI is anticipated to sell at about a $4 to $5 discount to Brent over the next decade or so. If you're an oil producer, of course, you would like those higher prices. But if you're investing in refining capacity that's going to be exported all over the world, this is a comparative advantage for you that you have access to a little bit less expensive feedstock. And this shows you the same thing for natural gas. So this compares TTF which is the tidal transport facility in Europe, the Dutch natural gas marker, to Henry Hub. And again, we have a cost competitiveness. Natural gas as well will trade at a discount relative to European natural gas prices. Again, if you're a natural gas producer, you would like a higher price. But if you're investing in all of this energy manufacturing that we're talking about, this is, again, a competitive advantage, which is anticipated to go into the future. Okay, and then we've got the pipeline expansions for natural gas, which a lot of that is bringing that natural gas from all over the country down here to the Gulf Coast region. And with that, I'm going to transfer to David to talk about the power sector, energy exports, and the energy manufacturing activity. David?
All right. Good morning, everybody. Hopefully the screen's working. We got it, Greg?
Yep, we can see you.
Okay, great. So let's talk a little bit about what's going on in the power sector. As we've done in the past, you can see that increasingly over the last several years, we've seen the Gulf Coast region's share of that overall market expanding. Something to keep in mind is, historically, we've seen pretty flat sales in the power sector over the last decade or more for a variety of different reasons. Increased energy efficiency activities that have all kind of culminated in the last decade or so, a doubling down of that in a lot of different sectors, particularly in the residential and commercial sectors. But this is an area I think to watch out for. We don't have that much built into this existing Gulf Coast energy outlook, but one of the things that I think you're about to start seeing is a pickup in this demand that may start to deviate from these historic trends that we've seen over the last decade or so in the aftermath of big natural gas price increases and big energy efficiency activities that have taken throughout the United States. The electrification activities in particularly the Mid-Atlantic, New England, and places out west are things that you shouldn't discount. Looking at those growth, new end uses, particularly in transportation through electrification, all those things, and the build outs that are getting facilitated by the things that Greg talked about in the IRA, I think are going to start changing this profile as we move forward. But to date, we've seen things relatively flat. And the only big growth sector that we've seen in power has been primarily through industrial, which is one of the reasons why you see this Gulf Coast share picking up considerably. And again, this just highlights that as we move forward for the U.S. overall, that hasn't been a big deal. But when you look at the Gulf Coast, you think about the unique nature of industrial and manufacturing activities in this region. It's relatively strong energy intensity. That is, 70-80% of its variable operating costs. And of that, you're looking 50-50 between gas and electric for a lot of these facilities, and a lot of pressure at the industrial level to electrify a lot of their end uses to push off emissions concerns that they have on site. You're going to continue to see numbers like this move and increase, although I think potentially a flattening out as we maybe see some slowing down on industrial activity on a forward-going basis. Overall, the industrial sector has seen relatively competitive prices over the last decade or so. One of the things that's unique, if you all remember, is during the 2000 period, a lot of our our industrial customers were kind of feeling the pinch, not only on their natural gas bills, but also in their electric bills, given the fact that such a high concentration of our generation in the region is generated from natural gas. The reduction in gas prices in 08, 09, 010 had a dramatic impact on power prices for the region. Then we've seen, a lot of increased repowering activities, new combined cycle plants at both the industrial level and the utility level, increases in thermal efficiencies that have helped this delta between the U.S. average and the Gulf of Mexico average spread. But we've seen some decreases of this over the last couple of years. And I think as states move forward with more programs that are addressing things like resiliency and reliability in the aftermath of events like Uri, other types of severe weather activity like what we've seen along the Gulf Coast with tropical activity, these billion-dollar programs that utilities throughout the region and throughout the United States, but increasingly now in the Gulf Coast region, are adopting as well. Those are going to put increasing pressure on base rates for a lot of electricity customers in the region, industrial in particular. And you see that closing in that gap. Whether this is going to be a catch-up and we start moving back to levels like we saw in 2000 is yet to be seen. But I think a lot of it has to do with what we see there, because if you just look at the fuel component and the thermal efficiencies of what's going on in just the power generation part itself, that wouldn't really constitute a reason for that compression in prices. So something else is going on, and clearly it's probably in those base rate and those base rate changes. By our sources of generation in the region, the big story here is continuing pickup of natural gas. We've seen relatively large amounts of natural gas generation throughout the United States, but coal continues to decrease year in and year out, with a bigger emphasis on natural gas to backstop a lot of that capacity. Renewables has been growing, but certainly not at the same pace as we've seen for natural gas. And as we move into the future, again, you start thinking of other uncertainties. Uri, I think, really pumped the brakes for a lot of policymakers in many areas of the United States on kind of what kind of resources they wanted to add. Many of you are probably familiar with the initiatives in Texas and the amendments that just passed there on the new Texas Energy Fund there to enhance capacity building activities for thermal generation that can be relied on. I've forgotten what the euphemism is there, but for dispatchable, I think is what it is, dispatchable resources. I don't think that's the last state you're going to hear that from. And something to keep in mind as we move forward, particularly if we have, as we enter into the heating season this year, if we have a bad set of events that occur during that time period. Looking at average industrial rates, and I'm focused on industrial since we tend to have a bit of an emphasis on bulk power markets, bulk commodity markets in general in the Gulf Coast energy outlook, and this plays into the discussion we'll have in a little bit about manufacturing development in the region. You can see that we're in a region that has really competitive prices. We're starting off with some of the most expensive prices here on the left-hand side, and the lower cost states on the right-hand side. And you can see for the Gulf Coast region, we tend to be well below those national averages, making for very competitive rates. For states that were in the New England region out west, you're paying industrial rates that are 16, 18%. Keep in mind, this is for industrial rates that most of your large customers are going to be interconnected at the transmission level. They're not going to be making big contributions in distribution investments and other costs. You add those in and you look at them for a residential customer. In places like Massachusetts, you're looking at rates that are in excess of 25 cents a kWh, close to 30 cents a kWh. You're looking at rates that are comparable to what you see in Western Europe right now. CO2 emissions have been falling both in the United States and in the Gulf Coast region. I think for the United States overall, most of that has been driven primarily by fuel switching and movement towards natural gas generation to meet capacity requirements. In the Gulf Coast region, particularly over the last couple of years, we've seen increases in thermal efficiencies help drive these. That's good both for CO2 and other types of correlated emissions going down, but it also helps in terms of increasing the efficiency of the generation and its costs in wholesale markets and driving down market clearing heat rate and prices overall. So that's good. But overall, we've seen those numbers increase as a share of U.S. total. And again, I think that's just kind of a moving of things around. If you look at where we've been in total, we're still seeing decreases. It's just some of those decreases have been faster in other areas where they've had much more room to essentially reduce those emissions than we have. Looking forward, you can see that we're still looking at a pretty big increase across the board in capacity requirements. 25 gigawatts, though, still of coal retirements. The good news is, I guess, we're not seeing things that are in the 38 to 40 to 45 gigawatts of retirement that we saw, a decade or so ago during the Obama administration. But unfortunately, just most of that low-hanging fruit in retirements has already happened. So we're going to start seeing that decrease, but they do continue and appear to be flattening out toward the end of the forecast horizon, which suggests that at least as long as we have reliability concerns and requirements that we have to meet, there's going to be some role for this type of thermal generation in the overall portfolio and generating stack of most power regions. Gas continues to pick up, but the big increases are going to be in solar and wind, particularly solar at 167 gigawatts of capacity. On the Gulf Coast, you see something comparable. It's a little bit different, obviously, than you would see in the upper Midwest or in the plains or for a U.S. average, since the proportion of growth in solar on the renewable side is going to be bigger than what we've seen in wind. 7 gigawatts compared to 77 gigawatts in solar. So a pretty big change. Smaller levels of coal retirements, but nonetheless still, 3,500 megawatts of retirements, pretty big. That's 3.5 nuclear power plants worth of capacity retirements on the coal side, and about 7 gigawatts or 7,000 megawatts of capacity additions in natural gas fired generation during that same time period through 2030. The interconnection for most of the MISO states is still dominated by a lot of renewable generation. In solar alone, we're seeing huge amounts, 30, 40 gigawatts of capacity in the interconnection queue. As most of you understand, those projects are announced projects, and projects on paper are just that. But still, even if you discount this by 50%, you're still looking at somewhere around 20,000 on an incremental basis in 24 to 26 time period. So still a lot. If all this were built out, you'd see tremendous capacity, several thousand, tens of thousands of gigawatts, even in Louisiana alone. At some point, Greg was talking about permitting issues. Permitting for renewables is becoming increasingly more and more challenging, as many of you are probably aware and have seen in the media, particularly for solar, particularly in the West Bank, that we've seen over the last year or so. That's going to continue to be a constraint, I think, as we move forward, and may limit some of the solar growth that we see in this region, and not just here, but in other places as well. On the energy export side, a big bounce back in Pad 3, which is the area that we're in terms of both capacity and utilization, in terms of the rebounds that we saw associated with COVID. Certainly some big deteriorating decreases in capacity from some shutdowns and overall refining abilities during that time period. But both from a flow perspective and a capacity perspective, we've bounced back pretty nicely and are getting close to pre-pandemic levels. Technically, we probably are, but not in the year or two prior to that. There's still certainly competitive pressures out there globally. Crack spreads are at great levels right now for refineries. How long that will last is certainly a challenge because of the volatility of these markets, and you can see that historic trend. But still, we're up a little bit better than we've seen throughout most of the last decade. Again, a lot of volatility, and what happens over the next year with the economy, particularly the global economy, and where that refined product demand is going to be, not only in Asia, but in Western and Central Europe too, where you're seeing diesel flows go over there at pretty high levels for a variety of different reasons. The Ukrainian crisis being part of that is going to be something to watch out for from a forecast perspective. We continue to see utilization levels being pretty strong and robust on a forward-going basis for both the U.S. And the and for the Gulf Coast region, and oil trade being pretty significant as well. Prior to 2015, when we had the embargo, we had very few to limited exports that occurred. We've seen a ramp up from practically nothing to close to 4 million barrels a day. That's probably going to flatten out a little bit as we move forward, just because of the constraints that we see developing these markets. These are all going to be driven by the opportunities that we see in Asia and other places, and what's going on in these international crude markets, between the amounts that need to be backfilled in from geopolitical concerns that Greg talked about earlier because of the Ukrainian crisis and other things going on, potentially in the Middle East as well. Again, you look at those crude oil exports. It's important for everybody to keep in mind. For those of you that aren't familiar, most of those are coming from our area. Most are coming from the Gulf Coast, from Pad 3, about 97% of those. Within the region, Corpus Christi has been carrying a lot of the weight of those exports. You compare those exports from 2018 to 2022, Corpus has seen the most gain. Houston is down a little bit, as many of these cargoes are more coming out of Corpus from crude oil flows from the Permian moving down into those areas. Beaumont is also down. Louisiana is relatively, from Loop, is relatively flat. Thinking back about those midstream constraints that Greg talked about, you're probably going to continue to see Corpus be pretty healthy until you start hitting a limit in terms of how that pipe capacity being used from the Permian, moving that crude down into Corpus, and to a lesser extent from the Eagle Ford moving out from Corpus, going out to the rest of these world markets, starts to fill up. When that does, you're going to see probably an immediate movement back into this opportunity in Houston here, as well as in Beaumont and other places. But it also opens up and is a big challenge for, what's the next era for capacity additions in oil exports. And we've got a number of projects that have been announced, particularly offshore. where you're likely to see where the bigger gains and opportunities are going to be for reducing reverse lightering activities that occur when you have a tanker that goes in, fills up, goes offshore, and tops off those tankers. You can minimize that by going into an offshore port that works a lot like LUT does, or like floating LNG facilities do, that can handle these VLCCs, these very large crude carriers, and are more competitive on a global scale than moving into actual physical ports. So this is something worth thinking about. Energy Transfer obviously has a project south of Louisiana. There are several off of the coast of Texas that are now. This is going to be much like LNG facilities, kind of the race to the finish line. Who gets there first? Who can sign up deals and contracts on outflows and capacity are going to be those that get preference, and those that miss it are going to be the ones that probably don't get developed. But something worth watching and thinking about as we move forward. Refined product trade has also been growing. This goes back all the way to 2012, 2011, when we started to become a net exporter. And those trends just continue to grow, particularly in the middle distillates that I talked about before, particularly with diesel, heating oil, other types, jet fuel, other types of things that have picked up post-pandemic to those levels that we saw before the crisis and even higher. And in LNG, we had some deterioration in export volumes last year. With the Freeport fire in Texas, once that facility came back online, we've been able to rebound and actually increase a little bit on the LNG side to where we've been in the past. But those are things worth keeping in mind, anywhere around 15, 16 BCF a day of capacity. We're starting to top off on that. What does the future hold for that? It's really hard to tell. But maybe another 5 more we could see that to raise up to closer to 20. But getting past that is going to be a bit of a challenge for a lot of different reasons. Again, those 23 volumes were down because of the fire, but we're you look at the month to months, we're back up to where we were pre Freeport accident. Overall, our exports to the world have been down a little bit. Keep in mind, these are in valuations, and so the oil and gas numbers are going to be down based on where oil and gas prices are, but still on a relative basis comprise a big share of what our exports are in the region. And again, a lot of those going out into Asia and the Chinese markets. Big stuff, energy manufacturing. What can we say about our project announcements? We continue to see big growth. What we talked about last year has almost doubled in terms of importance, and that is energy transition investments. Most of our new incremental investments in the region, as Greg mentioned before, are not only tied to energy exports, but also are tied to these transition investments. And what do we mean by that? Well, these are investments that are looking to reduce carbon emissions at these facilities, if not offset them. Green hydrogen, green ammonia, various different carbon capture, utilization and storage facilities, a variety of different things that are out there. These numbers really started to explode and increase after last year's GCEO. I think within 3 to 4 months after we had done the initial numbers, they were up by 30 to 40% by the beginning of the year. So we do this in November. By January, February, those numbers, both for Texas and Louisiana, were considerably higher. You're seeing a little bit more balancing out of this. A lot of big announcements on the transition investment side, moving up into Texas as well. So again, we're still around 50-50, but where we had an advantage up until the most recent year because of LNG, we're starting to see that tip a little bit in a different direction because of energy transition investments. Some of the big CCUS projects have been announced in the greater Houston region, and then this announcement more recently in the Permian Basin, which does get picked up in these numbers, because we opted to include those in there, since it's very likely a lot of the customers that will be utilizing those storage facilities are not only going to be in the partially in the upstream part of the business, but likely in downstream, down along the Gulf Coast, is something worth thinking about and accounting for. Texas, you're looking at somewhere around, moving out to the forecast period of 2030 from today, around $86 billion for Louisiana, or around 127. Note what we're looking at here in terms of growth in these transition investments that were charted out, somewhere around $79 billion in transition investments. So something worth keeping an eye out for, and something worth watching as we move forward. Again, one of the other big areas that I wanted to highlight for you all is just the increase in storage capacity that we've got in the area. Just from, again, these are for project announcements. As we move into the 07, 27, 28, 29 time period, most of these are anticipated to come online. I would suspect, given some of the things that Greg talked about on permitting delays, you might could see this forecast shift out by a year or two, depending on how that impacts those projects. But well in excess of 100 million tons a year of potential capacity in this region. That would be great when you start thinking about, Louisiana alone having that much in industrial emissions. So if you're looking for a tool that kind of the hub of the spoke that really moves decarbonization within the region, which I would argue is storage, because most of our cost-effective applications for decarbonization are going to be in these areas that are kind of blue in nature, not necessarily green, the ones that take and grab the CO2 emissions from an existing hydrocarbon and then sequester them, whether you're talking about ammonia, or you're talking about hydrogen, or you're talking about something else. You're going to need CCS to kind of bridge this in order to get to the green phase of this. You're looking in the power generation sector. We've got a project that's getting developed here in Louisiana alone on the power side, and I think you're likely to start seeing this more and more in natural gas generation, where these newer GE turbines that can facilitate hydrogen burns will start to do so. Those are all going to be facilitated by storage projects. And at least right now, we have an ample opportunity to facilitate those. And again, this does include the one that's in the Permian that was announced not too long ago. So with that, Greg, I'll turn it back to you.
All right, so now we're going to conclude with our employment forecast. And by the way, some questions have rolled in, but feel free to ask them at any time. So this is our Louisiana upstream employment. So this includes the E&P sector as well as the services sector. You can see pre-2014 price crash, Louisiana was having about 50,000 workers in that sector. We lost almost 18,000 workers during that price crash. That actually put Louisiana's economy into a recession while the rest of the U.S. economy was in expansion. We kind of flattened out, and then of course we had the pandemic. So in 2023, which is partially complete at this point, we're projecting that employment will be about flat in this sector. In 2024, we'll gain about 1,000 jobs according to the model. In 2025, about 300 jobs, and then it'll be flat thereafter. And so a lot of that is because of the upward pressure that we've had on prices here, as well as the production growth that we had just talked about. So this shows you the forecast for the last few years in order to see kind of how that performance occurred. So this is Texas upstream. So we actually estimate that in 2023, Texas actually lost about 1,900 jobs within the upstream sector. Interestingly, Texas, because of its boom-bust nature, still has more fluctuations than Louisiana. Of course, when it comes up, that's good. You like those employment increases, but in terms of the reduction, Louisiana gets less of them as well. In 2024, we estimate that they'll gain about 8,000 jobs, or about 4%. And then in 2025, about 2,500 jobs, and then it is flat thereafter. And here you can see our last few years. Kind of interestingly, you notice here that there are revisions to these numbers, and especially state level within specific sectors. Some of those revisions can be kind of large, which is what you see there. Okay, so the share of Louisiana upstream employment is kind of interesting. If you go back from 2010 to the pandemic, to pre-pandemic, you saw that Louisiana's share of total employment, Texas, Louisiana, upstream employment, Louisiana share was declining. But what's really happened is that's flattened off here into the future. And so that's kind of been interesting to see, as we've had less exposure, I think, to that boom bust that you still see in the shale formations, more and more exposure to that offshore as a relative share. What we see is that upstream sector is a little bit more stable relative to what it was historically. And we corroborate that with the Federal Reserve. They have their survey that they do of upstream producers. And that's consistent with what we see there. This doesn't actually go into the model, but it's one of those things that we look at. All right, so I'm going to switch it over to you, Greg, to talk about the employment forecast for refining and chemical manufacturing.
All right, thank you. Good morning to everyone, and thanks to Greg and David for easing me into the outlook process here. This is a gigantic effort on their part, and I'm glad to only have a little small part here, but it's been very interesting. in terms of refining and chemical manufacturing. The long run picture here is the long run driver here behind this employment numbers and forecast is the capital expenditure information that David puts together. And as those capital expenditures expand over time, the facilities expand, the employment expands, and that's what's the underlying driver for all of this historical period. You can see you can have periods where big macroeconomic forces that if you go back early 2008, 2009, the financial crisis, it held back employment without regard to investment, although that would have squeezed investment as well. And then, of course, the big picture one is on the right side here is pandemic. Without regard to investment issues, you had just a big drop in final demand for the products themselves, and that killed off some of the employment. But as we got into post-COVID recovery, you can see the employment coming back. The investment actually was falling off in 2019, so it wasn't all about COVID, but the investment is bouncing back as well, and we're recovering from the post-COVID environment. Going forward, as the investment activity continues, we have growth in the employment. We get to our pre-COVID 2020 roughly peak by the middle of 2023. We're pretty much back to where we were. We continue to grow. You got relatively rapid employment gains at first, 2.8%, 1.7, 1.6, but it starts to slow down back to the 1 to 2%. We kind of converge back to the post-COVID norm following the investment flows going in, and the big bounce, the rapid growth is really more a bounce back, and also driven by some investment surge, but a bounce back from the COVID dip. The next slide, Greg. This is employment in Louisiana. It's forecast comparisons, and then Texas is a similar pattern. I mean, it's still driven by investment activity, largely in Texas area. And you get that long run historical. You have Texas tends to see more cycling in Texas. It's bigger numbers, bigger levels, and you can see in the financial crisis 08, 09 and the Great Recession, Texas has much bigger dip than Louisiana has. But then it has a rapid climb out as the economy expanded over that decade. COVID comes along, knocks it down again. These are bigger drops than you see in Louisiana, but the same kind of general pattern. And then as you climb out of the post-COVID recovery, you get relatively rapid growth, and then we continue that growth, and it converges as the long run investment fundamentals take over again, and you end up converging back to that 1 to 2% job gain path, getting out into the forecast horizon in 25 and 26. And that, again, as long as you have this flow of investment coming in, you tend to have the job count growth that's consistent with that, then subject to these big macroeconomic shocks that overwhelm the fundamentals for at least temporarily. Okay, the interesting piece here is that to bounce back to those, for many years we had Louisiana upstream employment that was much greater than Louisiana refining and chemical, the downstream activity. Now, 2014, 2015 price collapse in oil prices, the Louisiana oil and gas extraction, the upstream employment fell off dramatically. And historically, when this happens, we never really get back to the previous peak, and we leveled off again. And then COVID dropped us again. The extraction side has gotten at least leaner employment wise. You have a little climb out, of course, as you recover from the post-COVID, the COVID trough. And then that's that flat projection that Greg had talked about. With refining and chemical, we have our COVID drop off, but now, and then our climb out and then converging back to 1 to 2% growth. But again, earlier years, much more employment in the extraction side relative to the refining and chemical. Now we have more employment in the refining and chemical side than we do in the extraction side. And I think that's true in Louisiana. I don't think you see that in the Texas slide, which is the next slide. Again, notice Texas has much more bigger cyclical activity, but and much bigger numbers, of course, in both sectors, extraction as well as refining and chemical. But its extraction side is going to stay bigger than its refining side for this foreseeable future. It doesn't appear that there's ever going to be if it's going to cross, it's going to cross many years out, as opposed to in Louisiana. The implications for that for Louisiana, I think, are on this next slide for the multiplier effects here, job multiplier effects. The upstream oil and gas activities have pretty good multipliers, 2 to 3+ jobs for every job in the extraction upstream sector. But oil and gas manufacturing has nearly twice as many jobs that are created in the economy overall for any given job in the oil and gas manufacturing, in the chemical and refining. And so the implications for the economy are that, because we now have more activity, job activity in the manufacturing side, the petroleum, coal products manufacturing, chemical manufacturing, we get a bigger bang for the job buck in effect in the Louisiana economy than we did if we were more heavily in extraction. Extraction is not unimportant, but manufacturing has become much more important in terms of its impact on the economy, and consequently the incomes generated from that.
All right, thanks, Greg. And I think and then we'll take some Q&A, but I think to me the biggest takeaways from this last year have been twofold. The first is the speed in which global markets have adjusted to the Russian invasion of Ukraine, which was the central theme of last year's outlook, have just been really astounding. I mean, just how quickly both oil and gas prices have moved back to those long-term trends. Last summer, there was media every single day almost of, electricity prices being high, gasoline prices being high, and all that's really settled down. And so I think the speed of the global market in adjusting to perhaps the largest shock one can imagine, the second largest natural gas producer in the world and the third largest oil producer in the world, and all these sanctions. So it's been very, very swift and incredible. The second big takeaway from me is really hearing how companies are talking about these decarbonization investments and really talking about that global perspective of how do we balance that cost competitiveness alongside those emissions reductions. And to me, those are the two biggest kind of takeaways from this last year.